predicts more than $13 billion we spent online with Amazon and other retailers. That's up almost 10% from last year.
Next, hey, update your resumes, folks, because there's about to be a hiring frenzy at Amazon.
Well, tomorrow marks the start of one of the biggest online shopping events of the year.
We're really happy to see some early Apple deals have already begun.
$250 million in cash. That's what Amazon.com founder and CEO Jeff Bezos has agreed to pay for ownership of the Washington Post and affiliated
did you know
publications.
This tomorrow marks the beginning of Amazon Prime Day.
In 1995, Amazon was a small online bookstore operating out of a garage. That year, it made about $500,000 in revenue, and it still lost money. There were no warehouses spread across continents, no delivery network, no cloud infrastructure powering the internet. Nearly 3 decades later, the same company would report over $637 billion in annual revenue and employ more than 1.5 million people worldwide. This transformation did not happen overnight, and it did not happen by accident. So the question is simple. How did a small online bookstore become one of the most powerful companies in the world? Amazon was founded in 1994 by Jeff Bezos, a former Wall Street hedge fund executive. The idea was simple. Use the internet to sell books more efficiently than physical stores ever could. When Amazon launched publicly in 1995, orders began arriving from across the United States and soon from around the world. Revenue grew quickly. Throughout the late 1990s, Amazon expanded aggressively while continuing to lose money. Each year, expenses climbed faster. But internally, Amazon was following a different strategy. The company was not trying to maximize short-term profit. It was trying to build scale. Amazon reinvested almost everything it earned into infrastructure, warehouses, technology, logistics, and customer experience. The goal was to grow faster than competitors, even if that meant operating at a loss for years. Bezos was explicit about this approach. Amazon would prioritize long-term market dominance over immediate returns. It was a risky bet, and at the time, there was no guarantee it would work. By the end of the 1990s, the internet economy was booming. Hundreds of new companies promised to change commerce, media, and communication. Many of them grew quickly. Very few were built to last. When the dot-com bubble burst in the early 2000s, capital disappeared almost overnight. Companies that depended on constant investor funding collapsed. Entire business models vanished. Amazon was not immune to the crash. Its stock price fell sharply, and critics questioned whether it would survive at all. The company had spent years losing money. But unlike many of its competitors, Amazon had been building something tangible: infrastructure, customers, and operational systems. In 2003, Amazon reported its first profitable year. It was a modest profit, but it marked a turning point. The company had proven it could sustain itself. Around this time, Amazon began expanding far beyond books. Electronics, music, DVDs, household goods, and everyday products were added to the platform. Amazon was no longer just an online bookstore. It was becoming a general retail destination. This period revealed a key difference between Amazon and many failed dot-com companies. Its losses were not the result of carelessness. They were the cost of a long-term plan. While others chased fast returns, Amazon focused on endurance, and that patience would soon begin to reshape the entire business. As Amazon continued to grow, it faced a problem few retailers had encountered before. Its systems were becoming too large and too complex to manage efficiently. In the early 2000s, Jeff Bezos made a major internal decision. Every team at Amazon would be required to build its software as independent services. These services had to communicate with each other through clear, standardized interfaces. No team was allowed to access another team's data directly. At the time, this decision was controversial inside the company. It slowed development and forced teams to rebuild systems from the ground up. But the long-term effect was significant. By breaking its technology into modular services, Amazon unintentionally created something else, a scalable computing platform. The company realized that the same infrastructure it used to run its own website could be useful to others. Instead of selling physical products, Amazon could sell computing power, storage, and databases. This became Amazon Web Services, or AWS. AWS allowed startups, corporations, and governments to rent computing resources instead of building their own data centers. Companies paid only for what they used. Over time, AWS grew quietly in the background. While Amazon's retail business remained low margin, AWS generated high profits. Eventually, it became one of Amazon's most important and profitable divisions. The company was no longer just a retailer. It was now a core part of the internet's infrastructure. Amazon has faced ongoing criticism across multiple areas. Concerns include warehouse working conditions and the company's opposition to unionization. Its technologies, from surveillance tools to AI devices, have raised questions about privacy and law enforcement partnerships. Allegations of anti-competitive behavior have emerged, alongside pressures on publishers and small businesses. The company has also faced scrutiny over content moderation, censorship decisions, and the use of data from devices like Ring and AI wristbands. Amazon's reach extends beyond commerce into government and military technology. Initiatives like Project Nimbus provide cloud services to governments, sparking pushback from employees and shareholders. New technologies, including AI-powered wearables that can record conversations, raise questions about data use, privacy, and consent. Today, Amazon is no longer just a retailer. It's a cloud provider, logistics network, advertiser, and data platform. Financially, it operates in trillion-dollar valuation territory, with revenue diversified across multiple industries. Its workforce makes it one of the largest private employers in the world, spanning over 1.5 million people globally. Amazon's growth wasn't the result of luck or sheer speed. It expanded through patience, careful control of infrastructure, and consistent long-term reinvestment. Ultimately, Amazon's story isn't just about online shopping. It shows how modern power is built quietly, layer by layer. Jeff Bezos stepped down as CEO, handing the reins to Andy Jassy. The board of directors is made up of former CEOs, government officials, and tech leaders, guiding strategy at the highest level. Bezos remains the largest individual shareholder, while major investors like Vanguard and BlackRock hold significant stakes, shaping the company's direction.